everyone, Daniela Camboni here. We hope you are enjoying our Outlook 2025 series. As always, I invite you, if you have any questions about the content, about our experts, or how to be best prepared for 2025 and win and thrive, then I highly urge you to reach out to one of my awesome colleagues at ITM Trading. You can do so by booking a Calendly appointment with them. You can find the link in the description below. Pick the time, the date that best suits you, and someone will be able to walk you through a wealth preservation strategy, building one unique to suit what's best for you, your life, your needs. It's an incredible process, and I urge everyone to do that. What can we expect from the stock market in 2025? Joining me today is guru and market expert Marc Chaikin of Chaikin Analytics. Marc, welcome back to the Daniela Camboni Show. So good to be with you. Happy New Year.
And to you, Daniela, what a treat to start the year off with a great interview.
Yes, absolutely. Well, hopefully you come bearing good news. I mean, we were just talking about the last trading day of 2024, which was ending on a sour note. What can folks expect in 2025? What do you see on the horizon?
I'm still bullish. As you know, I turned bullish on January 17th of 2023. We've maintained a bullish posture all the way through, expecting that the Fed would cut rates. And I think we're going to see tailwinds for stocks based on first quarter earnings, which will come out in January, mid-January, at the beginning of that 6-week earnings window. And I'm expecting us to continue on until the midsummer, where we might run into some choppy headwinds for the market.
What sectors particularly are you liking, Marc?
I'm liking two things: A, corporate earnings, and B, profit margins. I think the AI revolution is very real. There are a lot of naysayers out there, but it's not just the big chip stocks like NVIDIA or the software companies that are offering big data capabilities, but it's the downstream effect of AI on profit margins that I think is going to drive this market for not just 2025, but for a good 5 years out into 2030.
Well, you raise a good point. I mean, people looking at the Magnificent Seven thinking, what do we do here? And how do you expect the Mag 7 to perform under a Trump administration?
I think they'll do just fine, but we're looking elsewhere for buying opportunities because obviously these stocks have had a very big run. I don't think they're going away, however, and that's important. You're seeing a lot of headlines in the financial press that the Magnificent Seven has seen their day in the sun. I don't believe that, primarily because they're generating so much cash flow. If you want to go back to 2000 when the internet bubble was about to burst, a lot of the companies that were leading that charge didn't have the kind of earnings power and cash flow that the Magnificent Seven has. So I think that's really a big differentiator. And in fact, a little later on, I'll share an analog with you and your viewers in terms of where I think we are relative to the last big tech boom.
Yeah, please share it with us.
Well, I think that the introduction of ChatGPT in October, roughly October of 2023, is analogous to the Netscape browser, which was launched in 1994 and ushered in a 6-year boom in profit margins. And I think that we're about 2 years in. So I think we're in sort of the equivalent of 1996 in terms of where the NASDAQ is. And in fact, the NASDAQ percentage-wise is tracking that time frame from late 94 to the end of 96 pretty closely here. So I think there's a lot more to go. We may see a bear market in that time frame, but I think that we've got another 2 to 3 years, maybe 4, in terms of where the potential benefits of AI are going to be realized and where stock prices are going to start reflecting that.
You welcome AI, Mark?
Oh, absolutely. How can you not? I mean, we just wrote a piece today talking about the naysayers all along the way when innovation was in. Even going back to the introduction of the automobile, people say, "Oh, this will never work."
Right.
It's there's no infrastructure to support this. So yeah, I think you just can't write off AI. You've got to embrace it.
I want to talk the 10-year Treasury yield, which rose 100 basis points now since September as the Fed cut 100 basis points. Why the historic divergence? What is it telling us? What is it signaling, Mark?
Well, there's a group that affectionately known as the bond vigilantes who try and keep the Fed in line, if you will, and sort of adjust for not just monetary policy, but fiscal policy. So, what it's telling us is that the bond market doesn't think the Fed should be cutting any further. And in
Mm-hmm.
fact, they didn't like that first cut in September because they still feel inflation's a problem but the bottom line on all this for me is that the economy is strong. So the Atlanta Fed's GDP now model is projecting 3.2% GDP growth in the fourth quarter. These are big numbers coming on top of 2 years of a strong stock market. So I think what the bond market is telling us with rising yields is please don't go any further cutting rates because inflation is a problem and the economy doesn't need any help. Now, I'm not sure I agree with that, but that's what they're saying.
Inflation is a problem in so much that it remains sticky, or we could even see higher inflation.
Well, sticky, and some people are saying higher inflation. I don't see that because housing costs are a lagging effect on inflation rate, and housing costs are definitely coming down, but they're coming down slowly. But I think the stock market is all about earnings, expectations, and profit margins. And everything I see points to higher profit margins over the next 5 years. And the corporate earnings picture is fabulous.
So you feel that Trump will be inheriting a healthy economy, Mark?
Oh, absolutely. And, the sort of trend toward deregulation and maybe even cost cutting at the federal level is a very positive thing. Whatever your politics are, deregulation, especially in the financial sector, is welcome. And cutting fat in the federal budget, if they can accomplish that, is great because long term that can help reduce growing deficits that make a lot of the bond market people nervous as well.
I was just watching one interview. That's why I bring it up. That the guest was saying Biden is basically handing Trump a bag of rocks. There's 7 trillion of debt maturities in 2025. That's double 2024, nearly 4 times 2022. How grave is that situation?
I don't think it's a problem. It's been in the headlines for 30 years that the rising debt is a problem. But the fact is, the debt is probably going to go up because the biggest increase in debt came in the first Trump administration. So, depending on how Congress deals with the debt ceiling, and President-elect Trump has clearly indicated he'd like to see the debt ceiling lifted so he can implement some of his aggressive projects, infrastructure being one of them. Uh, I don't see the rising debt being a problem, and it's also one of the reasons that the Fed is cutting rates because the discretionary part of the deficit comes from servicing the debt. So if rates have come down like they are, that means that uh, financing the U.S. government debt is cheaper. So I don't see the Fed raising rates, and I see the Fed cutting slowly, but still cutting.
Mark, I've been asking all my guests on the Outlook series things that they're watching, warning signs, red flags in 2025, anything that you're closely monitoring here?
Well, I'm monitoring breadth, the stocks making new highs versus new lows on a 52-week basis, and also advancing versus declining issues. And clearly, December was not a good month for the internal breadth stats. So I want to see if we can play catch up in early January and see the majority of stocks participating because they did not participate. In fact, they got to oversold levels that suggest almost like a bear market bottom, but clearly the S&P is within shouting distance of its all-time high. So I'm watching the breadth numbers very, very closely to see if we can play catch up here in January.
Okay, but you're not expecting a crash in the S&P, Mark.
No, not at all. In fact, I would say a 5% pullback is about as much as we're going to see in the first half of the year, 3 to 5% max. So I think buy the dip is still operative. There's a ton of cash on the sidelines, 7 trillion in money market funds. The interest on that alone can drive stock prices up. And eventually, some of that money is going to come into the stock market, in my opinion. Not all of it, because people are very happy with the 5% yields you're getting.
Um, just before we wrap here, Mark, for folks new to your work, I'd love for you to just take a moment to explain where they can find more information on your work. I mean, we worked together before when I was at Stansberry and loved my time with you. Where can folks read more of your pennings and hear more of your thoughts?
ChaikinAnalytics.com, and we just released our 2025 forecast with a 10 stock portfolio, which is basically a buy and hold portfolio of stocks we think are going to outperform the market in 2025. And it's a diverse group. None of the very big names are in there, but there are some cybersecurity names, some travel stocks that are interesting, private equity companies. So ChaikinAnalytics.com, and for people who really want to dive deep, look at our 2025 portfolio event.
Mark, also your team sent me a link. People can go to stockmarketwarning.com. That's stockmarketwarning.com, and it will lead you to all of Mark's writings and work, and you can read and research and learn more. Mark, thank you so much for joining us.
You're welcome. And by the way, the stock market warning is not a warning to get out of stocks. It's to start getting into the stocks that are likely to outperform, because historically, after the presidential election, the biggest gains come in the first and second quarter of the following year. So what we're saying to people is you got to get on board. Just because we've had 2 years of plus 20%, don't feel like it's over. So that's really the warning. The warning is not get out. The warning is get in and get into the right
I
stocks.
didn't ask you this, but you know, a big part of my audience loves gold. Mark, do you make room for gold in your portfolio?
Only if it's in a mining stock with a bullish power gauge rating. So, along the way, we've had bullish ratings on Newmont Mining and some of the other gold mining stocks. But specifically, I leave gold to the experts and fall back on the power gauge rating.
There you go. Marc Chaikin, thank you so much. Happy New Year, and Happy New Year to all our viewers. Wishing you prosperity, wealth, and health above all else. Thank you so much for tuning in. We'll have more Outlook coverage for you. So be sure to stay tuned to the Daniela Cambone Show and subscribe to our YouTube channel to stay on top of it all. Thanks for watching. We'll see you soon.